Now that we understand the basics of internal versus external range liquidity, let's jump into an example on the charts just to see it in action and to convey it further using price action. And what we're actually going to do is we're going to move on to pound US dollar just to switch up the pair and continue discussing internal versus external range liquidity. And we're going to start on a blank chart, and we're going to look on the 4-hour chart here on pound dollar. And what we can see if we're looking at the most recent bit of price action is that if we're looking at the 4-hour chart, what we can see is we've broken structure to the downside. We were in a downtrend and we started to see a break to the upside, an initial change of character here, and a break of key swing structure in and around this point. And now what we can see is price is consistently making higher highs and higher lows and is forming proper structure as price continues on to the upside. So if we're looking at it from a 4-hour swing structure, we need to first identify the swing structure that we're working within to get a better idea of where price action is bound to be contained, map out a potential demand zone here on the 4-hour chart, and build in the internal and external range liquidity that would exist. So what we can see right here is we have this very large wick. And initially we can say that we have this large range that we can refine to this wick as a demand zone. What we can see is price is tapping into this demand zone as well. If we just scrunch the chart up just a little bit, we can see that we have some external range liquidity in the past that price will likely tap into, but just more specifically, there's a lot of liquidity that rests just above this high that we can look for price to take once it forms a higher high, if that is what market is intending. But what we can see is we are starting to create bullish market structure. So the expectation based on this newly found higher highs and higher lows is that we would form a higher low at some point and then continue moving to the upside, because as we know, price can move within the structural range and still remain valid bullish market structure as long as we don't violate this low in price. And then what we can also see so far is that this high has failed to take out this low, because as we can see, price has stalled here and is starting to move back to the upside. Therefore, based on that assumption, this would be a targeted high and this would be a protected low. So now that we have all of that information, we're going to really look into this leg of price action and then study this bit of price action on the 15-minute chart. So I'll just move the chart back just a little bit. And one thing I'll do is I'll just go back to the 4-hour chart and add visibility so we can see this on the lower time frames. Perfect. So now we'll jump back into the 15-minute chart. As we can see, we have our 4-hour swing structure, which is from this swing low to this swing high. And as we can see, if we just look at the 4-hour market structure, we can see that we create a high, we create a high, we create a high, create a high just right there. And then we start to switch from bullish to bearish market structure. So on the 15-minute chart, we can definitely say that we are in a bear trend starting at this point. And what we can derive this as, if we just draw a circle on there, that this is more of a 15-minute variance from the 4-hour, because as we can see, even if we look at this bit of market structure, this high here and this move here is, although we've broken above this high, we haven't closed above it. So in this case, what we can actually say is that we had a small pullback. We've taken some external range liquidity, and now we're starting to form an even bigger pullback, which gives us a little bit more indication that price is willing to move to the upside based on all of these factors. But as a result, this also sets up our 15-minute change of character from bullish to bearish. And then we can see that price is now caught within this structural range. So we'll go back down to the 15-minute chart. And as we can see, if we just look into this little bit of market structure really quickly, is we have internal range liquidity, some equal lows here, lows here, lows here. And what we can see, if we just dig into this a little bit more, if we're looking at 15-minute market structure, we're seeing higher highs and higher lows forming. And we're under the understanding that if price is to continue, we need to create higher lows. And we know that we need a catalyst to create a higher low in the form of a sweep of liquidity or a demand zone or the combination of two. And in this case, what we can see is we have a lot of liquidity, internal range liquidity being created. We sweep or take all of that liquidity, we tap into a demand zone, and then we continue moving to the upside, breaking the previous high. So what we can see is all of that liquidity is and has been taken. But what we can see when we just look a little bit further down, we can see that we still have some liquidity here in the form of swing lows. We have liquidity resting here. We also have a sweep of liquidity here. So if we're looking at this spot right here, we could derive that as a pretty solid demand zone. So we'll draw that on. And what we can see initially, and this is why we get a reaction, and again, this comes back to, we see reactions to supply and demand zones, but the most important thing for us as traders is, do we get a follow through of that reaction? And what we can see is we have a valid demand zone. We sweep liquidity here, continue moving on, creating higher highs and higher lows. Yes, we've switched from bullish to bearish. We have seen our change of character. And what we can see is that price initially reacts. We can see this on the wicks. So on a 1 minute time frame, for example, we would start to see a reaction. But then what we can see very quickly is that price does not respect this area, takes the liquidity that rests below. And what we can gauge from all of that is this is all internal range liquidity. If I just draw something like this, you can see that this is just a giant liquidity void. So we had a small liquidity void here that was filled as we continued moving higher, but we knew that there was still internal range liquidity resting below it. As well, we know that the 4-hour swing structure is truly this bit of structure. This was a variance, so to speak. And this variance exists so that the 15-minute can start switching bearish, so that we can actually start to see a 4-hour pullback and creating a higher low. So when we're looking at this bit of price action now, we can look at it in a couple different ways, because we've identified this demand zone, and we identified that on the 4-hour chart. We can see as we swept liquidity, we've created this very large wick. And what we can see is price creates equal lows. We tap into that, breaking the internal range liquidity that was generated here. And what we can see is we're now starting to create internal range liquidity as we start making highs, internal range liquidity, because all of this is internal of this overall 4-hour structure. And what we can see is we're starting to see reaction. And now what we're seeing is price is starting to make higher lows. And if we just look at market structure, we can see that we start to see a change of character on the 15-minute chart. We're starting to make minor structure, and we would use our lows here. So we'd still have minor structure. And what we can see is we broke this high. Our low would be here. We broke this high. Now we have low. So we're starting to see another change of character back to the downside, forming more substructure. And until this point, we could say that yes, price is more than likely going to start to move to the upside, because we're starting to see a strong trend. We're creating that minor structure. But if we just look to the left, now what we can see is we're interacting with a supply zone. And this is where looking at supply and demand and market structure and liquidity comes into play and becomes incredibly important. And it's why I'll stress all of these concepts in combination with one another. So what we can see is we have this supply zone. It's really the only supply zone that we've seen in this overall range that's been created on the 15-minute chart. It's what's created a break of structure. What we can see is we have a demand zone. We get a initial reaction from that demand zone, and then price breaks that demand zone, forming supply. This is what we know as a supply and demand zone flip. And again, we will get into that in the next sections, but just to get your mind thinking about where we're heading as well and how all of these pieces come into play, we can see that this was a great opportunity to look for sells. We built a lot of liquidity along the way. We've swept that liquidity. We've tapped into a 15-minute supply zone, and we're starting to push back down. Now, we could look at that in two different ways, and we'll go back up to the 4-hour chart really quickly and just look at what this may mean. So we know that price just wicked this high. We took the external range liquidity, and then we started to see momentum coming into the markets. So we could view that as, one, we're just starting to create a pullback to create a higher low and then continue moving to the upside. Or it could be the early signs that the trend is starting to change. We had a sweep of liquidity and we're starting to see price move to the downside. But we won't actually get a validation of that until we break this low. So always something to keep in mind, that although this may be an early sign that we're bound to continue lower, we don't actually know that until we break and violate this low. So until then, it's just something to keep in the back of our mind, that this might be an early warning sign that that's happening, because we're starting to see momentum come in the market. But we know we're in a fairly established bull trend. We still have some room to the upside on a 4-hour chart, for instance, to take external range liquidity. So looking for long opportunities does seem valid. We have this demand zone that is still intact. Price has stuck around for a while. Now we can look at it in the other light, that now that we've taken a lot of the internal range liquidity right here, we can see that if we were to draw something a little bit deeper, we'd still have this portion that could be tapped into. A lot of people like to see equilibrium or 50% of zone taps before they consider the zone completely absorbed. So in that case, we would still have room. But what we can derive, or what we can gain from all of that, regardless of if you view that, is that all of this price action that's being created right here is just creating more internal range liquidity. And what we could see is a much larger sweep or run on all of this sell side liquidity before we see the true move to the upside that would break this structural swing high, which would be our external range liquidity, and would see price moving. And this is why it's important to understand these concepts so that you can make the most informed trading decisions. Because if you were looking at this bit of price action, it does look like we're going to go off to the moon. Everything is lining up in our favor. But then we start to look at supply zones that still exist, and then we're starting to look at liquidity that's being generated and starting to combine the two. That's the most important part. Because if we didn't have something like this and price just seemingly started to come back down, we might have our narrative incorrect and we might be just focusing on liquidity for no reason. But the big thing is the fact that we have this supply zone. It came from a flip from demand to supply, and we're starting to see it react with a strong reaction. We know that we have a lot of internal range liquidity that still exists here. If we were to refine our zone on a 15-minute, we could look at something like this. And if we look at that, we can see that we haven't actually tapped into this zone. So what this would end up being is inducement, or a build up of liquidity for the sole purpose of grabbing the orders that rest below, the sell side liquidity that rests below, to tap into demand and then continue moving to the upside if we are to target this high and continue making a higher high and continuing on the bull trend. Because as we said, when we go to the 4 hour, this high has failed to take out this low. Therefore, this high in theory is targeted, and this low could be strong, but more specifically, this low would be strong because this low was successful in taking out these highs and these highs. So as a result, strong. This is our swing structure. We know that we are building our catalyst for a higher low to form if this trend is to remain bullish. And what we can see pretty clearly now that we've refined our zone on the 15-minute a little bit more is all of this is just liquidity that could be being built. And we're just seeing structural liquidity. We're about to see a breakdown of that. Now, whether we see a move to the upside and a target of this swing high, we'll have to wait and see how price action begins to develop over the next few hours or few days. But that's the concept of external and internal range liquidity, its importance, and how we actually use 15 minutes and 4 hour structure just to give a better understanding. Because if we were looking at structure again, we have substructure here. We'd be operating within a swing structure here. We break that structure here. This high here was successful in taking out this low here. So what we can see is this low has failed to take out this high, and we see price move. This low has been successful in taking out this high. Therefore, it should be protected. And this high has failed to take out this low here, therefore should be targeted. And what we can see is we target that high. This high fails to take out this low, and this low, therefore it should be targeted. And that's when we start to see price moving to the upside. Again, what we can see is this low is successful in taking out this high, but hasn't taken out this high yet. But based on that, it's cleared out all of this internal range liquidity. This low should be protected and this high should be targeted. And what we can see is price then runs to the upside, taking out this high, and price does move down, taking out all these lows. But again, these lows are still intact for the moment. Price then breaks this high, protected low, targeted high. Price then moves to the upside, breaks that high. And then what we can see is that this high is successful in taking out this low and this low. And we'll see if price does continue, because if price does continue, it just means that these lows become weak. And as we know, there's a lot of liquidity being built at this point here in the form of inducement. Again, what is inducement? Inducement is simply a fancy word for the buildup of liquidity for the purposes of being run. There are a lot of orders starting to be generated at these price levels for various reasons. People who are buying in this area, where would their stop losses be? Right here. People are looking to trade breakouts to the downside. Where are their orders likely to be? Here. People who are trading other various strategies, their orders here. Just in general, there are a lot of orders that are starting to be created here. And what we can see is we're starting to create liquidity voids, filled liquidity voids. We've created one large liquidity void that we've filled for the moment, but not fully. So we're starting to build that overall idea of what we're looking at here using internal versus external range liquidity, market structure, the three types of market structure, protected and targeted highs and lows, and then bridging it all with internal versus external range liquidity to start filtering out certain components. Because if we're looking within 15-minute structure for certain moves, what we can see is there isn't a whole lot of internal range liquidity that exists here. We have some right here. And then what we can see is on a lower time frame, this would be internal range liquidity. And what ends up happening, we take out that internal range liquidity, and that's when we target the lows. And if we just look in this move as we're pulling back, internal range liquidity, internal range liquidity, this would be more external range liquidity within the 15-minute because we were operating under this bit of swing structure. I'm getting a little bit more in depth on this because this is where we could actually break down this move and go on, say, a 1 minute and look at all the internal range liquidity that exists, which I could do. Let's just do that really quickly. So if we move in here, what we can see is that we have internal range liquidity, internal range liquidity, internal range liquidity, internal range liquidity, a lot of equal highs right there. Structural liquidity, which is internal liquidity. And then if we just move the chart, scrunch it up a little bit, and what we can see is we start to target all of it. We haven't quite taken all of it. As we can see, this area has yet to be taken. If I just put my cursor right here and follow the line to the left, and then what do we see? Price then comes up, takes that internal range liquidity. It has now taken enough orders that rest within these structures, these order groups, or this internal range liquidity before it continues to move to the downside. And then if I just hit price forward again, what we can see now, if we're looking on the downside, we're looking for internal range liquidity. We have internal, 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 internal. We're starting to see structural liquidity. So if we just keep playing price forward, there's no surprise why price is starting to move down in the way that it's moving. We're starting to take out pools. And what we can see is we get a reaction after we take out pools of liquidity or structural liquidity. See, reaction, reaction. We've just taken this out, reaction. We start to see price moving to the upside. It's no coincidence that this is happening. Nothing in these markets is random if you can start to understand all of these concepts together. And we can continue that on and on and on. But as you can see, price then creates a lot of internal liquidity as price then continues moving to the upside. We're all within this overall range. Again, we were looking at the 15-minute range of price here like this. And then as we broke down, we would be looking at this bit of internal range liquidity as price continues to move up. We take internal range liquidity, but what we end up doing instead is taking external range liquidity, because then we're starting to integrate the concept of the three types of market structure and protected and targeted highs and lows, because we know that once we break these highs, we've now switched from substructure to minor structure. And not only that, we discussed all of this on how these lows were failing to take out highs, but then these highs were failing to take out lows, and price was starting to move up. We then eventually took out the external range liquidity on the 15-minute chart. But again, we're building the idea on the 4-hour chart. We're building the idea using 4-hour swing structure, 15-minute structural liquidity, which we can use on the 1 minute. But what we can do as a framework in understanding this on another level is using 4-hour swing structure, looking at 15-minute internal range liquidity to understand where the 4-hour is likely to target. Then we can take that a step further to understand the 15-minute ranges. We can go down to the 1 minute and look at 1 minute internal range liquidities, especially when price action gets to this type of price action. This is where the 1 minute can be powerful in understanding our three different types of market structure, identifying the protected and targeted highs and lows, and then bridging that with internal versus external range liquidity in the 15-minute swing points. And that's the fractal nature of the markets. That's the best way to conceptualize all of these concepts and use a rule-based or systematic approach in building from the top down and the bottom up in that approach. Because again, initially we were building our idea off of 4-hour swing structure, and then as price started to create 15-minute structure, we could then use the 1 minute to understand what's happening here, what's likely to get targeted, just to understand everything that's going on within this range. So one more thing we'll do is just look at a completely different example. Is we're going to look at this bit of price action. So we can see that price has broken this high here. This was the change of character that we've seen on the 4-hour chart from bearish to bullish. We have a very large liquidity void that was created in the market, and that's ultimately what's been filled. And we've seen the formation of the bull trend and the continuation of that, which is what we're looking at right here. So again, what we'll do is we'll just look at price action in a slightly different lens, and we'll map on this high right here. We're going to map on this low right here. And then what I'm going to do also is just map on these highs right here. So we'll go down to the 15-minute chart again and just look at price action. So what we can see is initially when we're looking at this bit of structure, we're bearish. We have no inclination that price is going to run this high just yet. I'm sure if we looked at a higher time frame and started to look at what price taps into, there's more than likely a catalyst to the left, but we're not going to get into that. We're just going to focus on this bit of price action. So as price is starting to pull back, we're starting to create substructure. As we can see, we fail to create any minor structure as of yet. And as we can see, we're just starting to create more substructure. And we're starting to understand and ask ourselves, okay, where is internal range liquidity that price would be targeting more likely than not? And what we can see is we have internal range liquidity here, internal range liquidity here in the form of structural highs. And what we can see is as price is moving, we're also starting to create structural liquidity or structural lows in the form of liquidity. We can see that we take some of those lows, we take more of those lows. And then what we start to see is on a lower time frame, we start to see a little bit of a change of character, a demand zone, and then price starts to switch its sentiment. And initially what we can see is we take the internal range liquidity, we do get a reaction. What we can see is we can use this area as a supply zone. We don't get any real reaction, price just blasts through it. And what we can look at is the extreme supply zone right here, which is the last line of defense of the bear trend, because we know if we break this high, our bear trend is invalidated and we're now starting to create a higher high. And there's no coincidence that we take out internal range liquidity, tap into the supply zone, and we get a slight reaction. But again, there's no follow through on this reaction, because if there was follow through, then we would start targeting internal range liquidity to then target external range liquidity. But in this result, what we do is we created internal range liquidity. Price then takes that, we start to move into external range liquidity, and we're starting to create a range in price. And what we can see is as we've come up, we've created internal range liquidity. We've created a demand zone, which would be our catalyst for a higher low in the 15-minute chart. We can see price taps in and we start to create internal range liquidity because we're still operating between basically this swing structure in price. We do have potential internal range liquidity down here as well, and potentially within here on the 1 minute. And this is where we need to understand our catalyst in terms of why a higher low would be forming, whether it's a demand zone, a sweep of liquidity, or the combination of both. In this case, what we can see is we get a sweep of liquidity and a tap into a demand zone, and that's what causes price to continue upside. We look at it in a different lens. We say that this high has failed to take out this low, this low, this low. Therefore, it should be targeted. This low should be protected, and we should see price run to the upside. And we do see that, and price does continue moving to the upside. And what we can see is now we start looking at external range liquidity, because all of this is external to the range that we're working within. And what we can see is the next logical step would be here, here, and we can see, again, we take out this external range liquidity, we get a reaction. And what we can see is we have a demand zone right here. We know that we need a catalyst to form some sort of higher low. And again, that's in the form of liquidity being swept, a demand zone, or the combination of two. And as we can see, is we get a tap into a demand zone. Price then creates a new high. We look to the left, where is external range liquidity. We have a little bit here in the form of structural highs. We have equal highs right here. We have more structural range liquidity. As we can see, we take that liquidity. We get a reaction, no follow through. We take these equal highs here as well. We get a reaction. Price continues moving to the upside. Where does price move up to? Move up to more external range liquidity. We just maintain this bit and we start to see our pullback. And then what we can see is we have a demand zone right here that price doesn't really look like it taps into. We can use the inside bar. Basically, the demand zone would be within this range, as we have this really large wick. We have this bit of price action. So either option is valid, but as we can see more specifically, even just for the qualification of a higher low, we sweep liquidity and then we tap in. We have some external range liquidity, and then that's where we can start to look to the upside. And what we can see for the moment is that price is maintaining external range liquidity. We started to create this. So if we go back to the 4-hour chart, now what we can see is on the 4-hour chart, we're starting to create an actual pullback, and this is why this area of external range liquidity was maintained. So we'll just go back down to the 15-minute chart again, and we start to look at, okay, now that we're seeing the 4-hour pulling back, we're seeing the respect of this internal range liquidity. We're seeing that price is moving to the upside, but we know that the higher time frame needs to have a deeper pullback. We're going to look for internal range liquidity once again to get tapped into. So what we can see is initially we had this as our demand zone. We didn't actually break the high. And what we can see is this was used as inducement, or again, a fancy word for the buildup of liquidity to get run. we can see that we have a liquidity void that gets filled. Again, I pointed out this demand zone, this wick, and what do we tap into? We tap into that and we start to run off. We're targeting internal range liquidity. This is all internal range liquidity here as well that's been tapped into. We build more internal range liquidity. We consolidate here. As we can see, we have a pivot demand zone as well as a potential extra entry before price then moves to the upside. We target the external range liquidity. Again, we start to create equal highs. We run those highs. We can see that we are now starting to take more external range liquidity. We form more external range liquidity that we're starting to target. But again, what ends up happening right here, we start creating equal highs. We need to start targeting internal range liquidity. We have this swing low here. What do we have right here? A demand zone. It's starting to get a little messy, but what we can see is we sweep liquidity. We sweep liquidity. We've tapped into a demand zone. We have the qualifications we need for a higher low. If I go back up to the 4-hour chart, what we can start to see is we do have a pullback on a 4-hour chart, a little bit more of a messy pullback in my opinion, as it is sort of a pause in the market, but this is more definitive of a pullback with this bearish candle versus something like this, where this is more so a more of a pause in the markets. And if we look to the left, what are we reacting off of? We're reacting off of supply. And as a result, we do get that reaction, no follow through. That's why we were looking at this wick, because this is a supply to demand flip. Again, we're going to talk about supply and demand zone flips in a future video, but just again, to get your mind thinking. But as we can see, even on the 4-hour chart, now we're looking at external range liquidity. We've taken that. We're about to take that. We take that and then we continue. And then we just scrunch up the chart more and see any other external range liquidity that exists. And these are all future targets that we would potentially be looking at price to run on if our expectation is to remain true that price is going to continue bullish. So now what I recommend is really understanding the concept of internal versus external range liquidity in understanding pullbacks, looking at external range liquidity to understand when a higher high or a lower low is going to form in the market. Because as we've seen on the 4-hour chart, using the 15-minute, we could identify external range liquidity that these areas were targeting. Once we started to see a 15-minute external range liquidity area that was being respected or price was not breaking, we started to see a 4-hour pullback, and then eventually we seen price break that external range liquidity, targeting more external range liquidity. As we see price pull back, creating either a higher low or a lower high, depending on the trend, we can see that price targets internal range liquidity. We're building up orders. Again, this goes back to the liquidity basics video, where the main fundamental component of what's going on a price chart is that orders are being facilitated. There's imbalance that exists within the market on supply and demand. For every buyer, there needs to be a seller, and for every seller, there needs to be a buyer on the other end in order for transactions to facilitate. When that balance does not exist, price needs to move up or down in order to tap into pools of liquidity or pools of orders. And in order to do that, that then balances the market, which then causes price to move. When there's no liquidity, price needs to move rapidly. When there is liquidity, price tends to consolidate because there's a fair value of orders that exist. Buyers and sellers are in harmony. They're willing to exchange their orders from buy to sell, sell to buy. And then again, we can use the concept of liquidity voids to understand that even further, because we had this swing structure. We know that this is an open bid of price. There's a lot of internal range liquidity, even just on this bearish leg. So chances are that price is going to fill this liquidity void before anything really happens. But again, if we look at other examples, we have larger liquidity voids that haven't been filled yet. It takes time to fill these liquidity voids. And I know that we dug into liquidity voids in the liquidity basics, but now I'm hoping that this video bridges that and explains the concept of liquidity voids even further on why it's actually happening. We're targeting internal range liquidity or external range liquidity, depending on how the liquidity void is being created in relation to market structure, supply and demand, and everything like that. So again, hit your charts, map out internal versus external range liquidity in relation to your market structure, your 3 different types of structure, using the 4-hour swing structure as your basis, your 15-minute to identify your internal range liquidity within that 4-hour leg. And then what you can also do is use, say, the 5-minute or the 1-minute to then look at the 15-minute as your swing structure and look at the internal and external range liquidity within those. It's going to give you a massive insight as to what's going on behind the scenes in a price chart. Initially, it might be confusing. You may have to watch this video a few times to truly understand the inner workings of this, but the best thing you can do is start to apply this to the chart. get really familiar with this, how it relates to market structure and supply and demand, and it's going to give you an inside edge in terms of understanding order flow and where price is likely to be drawn to on a price chart.